Welcome back to Boni's Life, the channel where we decode the noise, analyze the data, and uncover the real truth driving the financial markets. I am your host, Boni, and today we have an absolute masterclass lined up for you. We are diving deep into the cryptocurrency market, breaking down exactly what happened over the past trading week from Monday, May 18th to Friday, May 22nd, and projecting the critical events that will dictate the flow of capital in the upcoming week. This is not your average market recap. We are going to look at the intersection of geopolitics, macroeconomic shifts, derivatives positioning, and raw on-chain data to give you the most accurate, balanced, and intellectual perspective available anywhere. If you are serious about understanding where the smart money is moving and why the markets behaved the way they did, you are in exactly the right place. So grab your notebook because this is going to be dense with alpha. Let's get straight into it. Let us start by looking at the broader macroeconomic picture and the geopolitical chess game that dominated the headlines and the charts this past week. The reality is that crypto does not exist in a vacuum. It is highly sensitive to global liquidity conditions, interest rate expectations, and international stability. This week, we saw a massive geopolitical scare that sent ripples through every single asset class. Tensions in the Middle East escalated significantly, with the threat of a major military strike by the United States on Iran looming large over the weekend heading into Monday. This caused Brent crude oil to spike to $112 a barrel, triggering immediate fears of renewed inflation across the global economy. When oil spikes, the cost of transportation, manufacturing, and food production goes up, and central banks are forced to keep interest rates higher for longer to combat that inflationary pressure. This is the exact opposite of what risk assets like Bitcoin want to see. The 30-year US Treasury yield hit 5.138%, the highest daily close since 2007. The VIX, which measures market fear, set at 17.82. Gold surged above $4,500 per ounce as investors piled into traditional safe havens. However, in a dramatic turn of events, President Trump called off the planned strike on Wednesday following urgent appeals from Gulf allies, citing serious ongoing diplomatic negotiations with Iran. As a result, we saw oil prices retreat from $112 back to the $102 level by Friday. This de-escalation provided a massive sigh of relief for global markets. The Dow Jones Industrial Average hit a record high on Friday, while the Nasdaq 100 and S&P 500 rallied 3% and 1.7% respectively from their midweek lows. But what did this mean for crypto? Initially, the fear caused a significant sell-off. On Monday, May 18th, Bitcoin dropped sharply to around $76,800 as US spot Bitcoin ETFs recorded approximately $448 million in net outflows in a single day. But as the geopolitical fears subsided through the week, Bitcoin recovered, climbing back to $77,447 by Thursday, May 21st. This perfectly illustrates how sensitive the crypto market is to global stability. When the world looks dangerous, capital flees to safety in dollars, treasuries, and gold. When diplomacy prevails, risk appetite returns and flows back into equities and crypto. But geopolitics was not the only major macro event this week. We also saw a historic shift at the United States Federal Reserve that will have profound implications for every financial market for years to come. On Friday, May 22nd, Kevin Warsh was officially sworn in as the 17th chair of the Federal Reserve at the White House, the first Fed chair swearing in held there since Alan Greenspan in 1987. He succeeds Jerome Powell after the closest Senate confirmation in the modern era, with a vote of 54 to 45. Why does this matter to us as crypto investors? Because Kevin Warsh represents a potential regime change in monetary policy. He has publicly advocated for what he calls regime change at the Fed, including tighter coordination between the Fed and the Trump administration, faster runoff of mortgage-backed securities and government bonds from the Fed's balance sheet, and a complete overhaul of how the Fed communicates with markets. While the Fed funds rate currently sits steady at 3.50% to 3.75% after 3 consecutive 25 basis point cuts in late 2025, the market is now pricing in less than a 3% probability of any rate cut for the remainder of 2026. In fact, some trading desks are even raising the probability of a rate hike by September, given that the consumer price index sits at 3.8% and the producer price index jumped to 6.0% year over year in April, the highest since December 2022. This higher for longer narrative is a massive structural headwind for Bitcoin, as it makes risk-free yields more attractive compared to volatile digital assets. Now let us dive into the specific day-by-day performance of the crypto market this week. On Monday, May 18th, the market opened under severe pressure. Bitcoin dropped to approximately $76,800 as the Iran strike fears peaked. The total crypto market saw over $1 billion in liquidations, with long positions being absolutely decimated. US spot Bitcoin ETFs recorded $448 million in net outflows. On Tuesday, May 19th, Bitcoin recovered slightly to approximately $77,100 as traders began to digest the situation and open interest in Bitcoin futures fell as leverage positions were trimmed. On Wednesday, May 20th, Bitcoin climbed to $77,262 as the geopolitical de-escalation became clearer. Japan's Q1 GDP came in at 2.1% annualized, beating expectations, which provided some positive sentiment for Asian markets. On Thursday, May 21st, Bitcoin reached $77,447 as altcoin rotation accelerated and the Dow Jones hit a record high. And then on Friday, May 22nd, we saw a sharp breakdown. Bitcoin dropped 3.3% in 24 hours to $74,659.16 as Kevin Warsh was sworn in as Fed chair, and the market digested the implications of a potentially more hawkish monetary policy regime going forward. Let us now examine the numbers in detail. As of the close of the trading week on Friday, May 22nd, 2026, Bitcoin is trading at $74,659.16 according to CoinGecko. This represents a 3.3% decline over the last 24 hours and a 4.7% drop over the past 7 days. The market capitalization stands at $1.49 trillion with a 24-hour trading volume of over $59 billion. Bitcoin dominance remains strong at 58.1%, indicating that capital is not yet flowing aggressively into altcoins on a broad basis. The total cryptocurrency market capitalization is $2.576 trillion, down 3.2% from the start of the week. If you had invested $100 in a spot Bitcoin position at the start of the week on Monday when Bitcoin was hovering around $78,135, your investment would now be worth approximately $95.55. You would have lost about $4.45, or 4.45%. For Ethereum, a $100 investment at the start of the week at approximately $2,193 would now be worth $92.40, a loss of $7.60. For Solana, $100 invested at $87.34 would now be worth $93.80, a loss of $6.20. These numbers tell us that this was a losing week across the board for spot holders. From a technical analysis standpoint, Bitcoin has been confined to a very tight channel between $76,100 and $78,000 from Monday through Thursday before breaking down decisively to the $74,600 level on Friday. The lack of upward momentum is telling. When we look at the derivatives market via CoinGlass, we see that total open interest for Bitcoin perpetual futures sits at around $25.49 billion. The broader open interest range for Bitcoin has been 720,000 to 750,000 Bitcoin. What is fascinating is that funding rates have remained broadly negative for several weeks. This means that the leverage majority is positioned short, expecting further downside. Furthermore, the 30-day implied volatility for Bitcoin has dropped to a 7-month low. Options traders are relentlessly selling volatility, primarily through call overwriting, which means they are selling upside potential for premium income. Put activity is heavily concentrated at the $71,000 to $77,000 strikes on Deribit, the largest crypto options exchange. Total crypto derivatives volume reached $160 billion in the last 24 hours, while liquidations declined 26% to $200 million. suggesting a calmer but cautious market. This setup tells us that the smart money is bracing for a continued range-bound market with a slight downward bias, hedging against potential drops rather than betting on an explosive breakout. While Bitcoin has been relatively stagnant, the real action this week has been in the altcoin market. We are witnessing a classic sector rotation pattern that experienced traders will recognize immediately. As Bitcoin flatlines, speculative capital moves down the risk curve, looking for outsized returns in smaller, more volatile assets. Ethereum, the second largest cryptocurrency, is currently trading at $2,026.52, down 4.5% in the last 24 hours and 7.6% for the week. Its market cap sits at $244.5 billion, with $16.5 billion in daily volume. Solana is trading at $81.93, down 6.0% in 24 hours and 6.2% over the last 7 days, with a market cap of $47.3 billion. However, the standout performers have been in the artificial intelligence sector. Tokens like NEAR Protocol surged by 28.5% in a single day, with its open interest hitting a record high of 282.53 million tokens. FET gained 11.4%. We also saw massive moves in specific ecosystem tokens like HYPE, the native token of the perpetual exchange Hyperliquid, which surged an astonishing 60% from Tuesday to Friday to hit a record high. This was driven by heavy short liquidations and strong institutional demand following the launch of US spot ETFs for the token. The CoinMarketCap altcoin season indicator has climbed from 31 to 38 out of 100, showing that the rotation is picking up steam but has not yet reached full altcoin season territory. Let us also take a close look at XRP, which has been a major focal point for institutional investors recently and has a critical catalyst approaching next week. XRP has been trading in a tight range between $1.31 and $1.38 this week, with the weekly close at approximately $1.3752, down 0.99%. Technically, it is facing heavy resistance. It was rejected at the key $1.50 level and is currently trapped below the 20 and 50 weekly exponential moving averages. The parabolic SR on the weekly chart has flipped to a bearish dot above the price, a classic signal that the prior uptrend has lost momentum. The RSI sits at 37.44, well below the neutral 50 line and approaching oversold territory near 30. On the XRP/BTC pair, the price has broken below the lower Bollinger Band, and some analysts are projecting a potential 40.5% decline to 0.000011 BTC if the descending triangle pattern plays out. However, beneath the surface, the fundamentals tell a completely different story. Over 403 million XRP left Binance between May 3rd and May 15th through whale-sized transactions, indicating that large holders are moving their assets into cold storage for long-term holding. Furthermore, XRP-linked investment products saw $60.5 million in weekly inflows, the strongest weekly total of 2026. The network recorded over 69,000 weekly active addresses and 48,453 active addresses in a single 24-hour period, the highest since late March. The smart money is accumulating quietly while the retail market focuses on the stagnant price action. This brings us to a critical catalyst for XRP that is happening next week. On Tuesday, May 27, 2026, the XRP ledger faces a hard deadline for the activation of version 3.1.3, specifically the Fixed Cleanup 3_1_3 amendment. This amendment entered its 2-week activation window on May 13th and locks in on May 27th. This is a major technical event with real consequences. Validators running outdated software after this date will face amendment blocking, cutting them off from consensus entirely. This upgrade bundles crucial fixes for NFTs, permissioned domains, vaults, and the lending protocol. As of May 18th, roughly 40% of the network had yet to upgrade, leaving a significant portion at risk. This creates a binary scenario. Either the network upgrades smoothly and the accumulated supply pressure from whale accumulation finally pushes the price higher toward the $1.50 resistance, or coordination failures among validators trigger a deeper retracement below the $1.33 support toward $1.20. This is a high conviction trade setup that demands attention. Looking ahead to the upcoming week of Monday, May 25th to Friday, May 29th, we have several major events that will dictate market direction across all asset classes. First and foremost, all eyes will be on the new Federal Reserve Chair, Kevin Warsh. This will be his first full working week in the big chair. Markets will be hyper-analyzing every statement, every speech, and every leak to gauge his exact policy direction. His first FOMC meeting as chair is scheduled for June 16th to 17th, and the language he uses in the lead-up will set the tone. If he signals an aggressive reduction of the Fed's balance sheet or hints that rate hikes are back on the table to combat the lingering 3.8% CPI inflation and 6.0% PPI, expect a swift negative reaction in risk assets, including Bitcoin. Conversely, if he takes a more measured, data-dependent approach, we could see a relief rally across all markets. We also have significant economic data releases coming up that will move markets. The markets will be closely watching the upcoming US PCE inflation data, which is the Fed's preferred measure of inflation and carries more weight than the CPI in terms of policy decisions. Any upside surprise here will solidify the higher for longer narrative and pressure Bitcoin downwards. Additionally, we have the continuation of the G7 finance ministers meeting in Paris, where global economic coordination, trade policy responses to tariffs, and potential new regulatory frameworks for digital assets will be discussed. The U.S. Senate Banking Committee has already approved the Clarity Act, which could reshape crypto regulation. On the geopolitical front, the ongoing negotiations between the U.S. and Iran remain a wild card that could swing oil prices by $10 or more in either direction. If talks break down and the threat to the Strait of Hormuz resurfaces, oil will spike again, dragging down the crypto market with it. The 30-year Treasury yield at 5.138% is already putting enormous pressure on all risk assets, and any further rise could trigger a broader market correction. So, how do we trade this environment? Let us look at the potential scenarios and assign probabilities based on the data we have analyzed. Scenario 1, the range-bound grind. Probability, 60%. In this scenario, geopolitics remain stable, but inflation data comes in hot, and Fed Chair Warsh maintains a hawkish but measured tone in his first week. Bitcoin continues to chop between $71,000 and $77,000 with low volatility. The technical trigger to watch here is the $74,000 support level. If we break below that with volume, we are likely heading to the lower end of the range at $71,000. In this scenario, the smart play is to sell covered calls on existing Bitcoin positions to generate yield in a flat market, maintain tight stop losses, and look for rotation opportunities in strong altcoin sectors like AI tokens and DeFi protocols that are showing relative strength. Scenario 2, the hawkish breakdown. Probability, 25%. In this scenario, Kevin Warsh comes out swinging in his first public statements, signaling that the Fed is seriously considering a rate hike by September to crush the 3.8% CPI inflation and 6.0% PPI. Combined with a potential failure in the XRP ledger upgrade on May 27th, causing broader market jitters, and a breakdown in Iran-US negotiations pushing oil back above $110, we see a flight to safety. The technical trigger is a decisive daily close below $71,000 for Bitcoin on high volume. This would likely trigger a cascade of long liquidations across the derivatives market, pushing the price down toward the $65,000 to $68,000 macro support zone, where significant buy-side liquidity is clustered. If this happens, you want to be in cash or stablecoins, waiting patiently to deploy capital at those deeply discounted levels where the risk-reward becomes extremely favorable for long-term accumulation. Scenario 3, the relief rally. Probability, 15% in this scenario. US PCE inflation data comes in surprisingly cool, showing meaningful deceleration. Geopolitical tensions ease further with a breakthrough in Iran-US negotiations. Fed Chair Warsh adopts a dovish tone in his first week, assuring markets that the current rate of 3.50% to 3.75% is sufficiently restrictive and that patience is warranted. The XRP ledger upgrade on May 27th goes flawlessly. sparking a massive rally in XRP and broader altcoins. The technical trigger here is a high-volume breakout above the $78,000 resistance level for Bitcoin. This would force the heavily short-positioned derivatives market to cover their positions, creating a violent short squeeze that could propel Bitcoin back toward the $80,000 to $82,000 range within days. In this scenario, you want to be heavily allocated to high beta altcoins like NEAR, FFET, and HYPE, alongside a core spot Bitcoin position. To conclude, the crypto market is currently in a state of high tension, caught between the opposing forces of institutional accumulation on one side and macroeconomic headwinds on the other. The era of easy money is definitively over, and we are entering a phase where deep analytical understanding, patience, and disciplined risk management are the only ways to generate consistent alpha. The smart money is not panicking. They are hedging their bets through option strategies, accumulating strong assets like XRP in cold storage during periods of weakness, and waiting for the macro picture to clarify before making aggressive directional bets. As retail investors, we must adopt the same mindset. Do not get chopped up in the day-to-day noise. Focus on the data, understand the geopolitical landscape, respect the power of the Federal Reserve, and always manage your risk. Position sizing is everything in this environment. Thank you for joining me on this deep dive into the crypto markets. If you found this level of analysis valuable, and I know you did, make sure to hit that subscribe button, smash the like button, and leave a comment below with your thoughts on Kevin Warsh's appointment and which scenario you think is most likely to play out next week. Share this video with anyone who needs to understand the real forces driving the crypto market, because this is the kind of analysis that separates the informed investor from the crowd. Remember, intelligence is your greatest asset in these markets. Stay sharp, stay informed, stay disciplined, and I will see you in the next episode of Boni's Life. Peace.